UK citizens will finally voice their opinion regarding the UK's membership in the European Union. The referendum is due on June 23rd. We expect to get the early results by 3 a.m. London time on June 24th and have a clearer picture by 5 a.m. This means that all traders in the European time zone are recommended to make sure they have their stop losses, take profits, entry and exit levels up and running, as this activity could take place during the overnight trading hours. The market has been actively hedging against the Brexit risk for the last 3 months. The ratio of put options against call options on British pound reached historical high proportions. The pound dollar lost 13.5% from June 2015 to March 2016, and the pair has been trading below the 50% retracement level of 148.83 since last January. The implied volatility, meaning the volatility extracted from the option markets, reached 28% last week. The realized volatility on pound-dollar spot market climbed to a 7-year high. Now, if we examine the implied volatilities extracted from the GBP USD spot market, as of today, the market prices in no more than 30% probability for the UK to leave the European Union. This is down from almost 50% last week. So the opinion polls are clearly too close to call. On the latest Bloomberg survey, 45% of those surveyed said to expect the UK to stay in the European Union. 44% thought that the Brexit could actually happen, while 11% had no idea on what to come. Although the opinion polls and surveys happen to be fairly inaccurate over the past couple of important events, as the Scottish referendum and 2015 general election, the market reaction to these polls give an idea on how seriously the Brexit risks are priced in and how much potential we could expect on the upside or on the downside once the results are out. In London, suspense is in the air, and despite all the surveys and opinion polls available out there, the reality is that no one could tell what will happen. History can only tell whether or not the close call in opinion polls was just a coincidence or if it was part of reality vis-à-vis the UK's discomfort at the heart of this European Union. The pound dollar trades at about its 200-day moving average, which currently stands at about 146.80. This and call expiries are expected to lend support about the 145 mark before the June 24th. The bias turns negative below this level. The EURGBP is consolidating below the 0.77 mark this morning. Onwards, a no vote is expected to trigger an immediate relief rally in GBP crosses. The pound dollar is seen climbing to the 150-155 range, while trend and momentum indicators remain comfortably negative in euro pound for a potential extension toward the 200-day moving average, which stands at 0.7570 level. In the alternative case scenario, a Brexit vote should obviously trigger a knee-jerk sell-off in the market, because despite a solidly hedged market, the majority of traders and investors did not price in the Brexit as a base case scenario. A Brexit event could be expected to drag the pound dollar below the 140 level immediately and toward the 130 mark in term, meaning you could perhaps count 3 to 6 months for this to happen, and it could only send the euro pound up to 0.80-0.85 range. On Wednesday, the FTSE remained upbeat for a third consecutive day in London. Better oil and commodity prices have certainly played a role, but more importantly, the market appears to have briefly pushed the Brexit risk aside. In the wake of the Brexit referendum and after, we accept divergence in sector performances. Financials, banks, construction and housing stocks are very sensitive to Brexit-related volatility, while healthcare, consumer staples and utility stocks are expected to fluctuate less, both on the positive and the negative side, on the run to the referendum and throughout the period where the market will be interpreting, digesting and readjusting according to the outcome. In the very short run, we mentioned that we have seen some decent positivity across the market since Monday. Nevertheless, the sentiment could rapidly turn sour should the slightest panic hit the headlines. Any sell-off could gain momentum, as many investors would not hesitate to close their long positions and turn flat, walking into the referendum, which is understandable. And the FTSE index offers are eyed at 6,325 zone. In case of a no vote, we expect the FTSE to take off toward the 6,500 to 6,800 range, while a Brexit vote could cause a sharp fall toward the 5,800 to 5,500 range. Good luck trading.